Hi, this is real estate broker Jessica Carter. Happy Friday. Let's take a quick look at some local stats and then we're going to dive right in to national housing market data just released because you want to know what's going to happen next year in 2026. First of all, last November stats came out and we are at a 2.3 month supply of inventory for single family residential. And you know what that means if you've been following me all year. It is a seller's market. However, in the condo sector, we are at a average month supply of inventory at 3.6 months. So that's a balanced market. That means that we are shifting. We could see a buyer's market next year. Now, at a national level, let's talk mortgage rates because even in normal years, they move a lot more than people realize. A new analysis from Resi Club using Freddie Mac data shows that since 1972, the 30-year fixed mortgage rate has averaged 1.4% swing each year. Even if we only look at this century since 2001, the average annual rate is still 1.08% swing. That means rate environment is normal and it affects monthly payments in a big way. For example, on a $400,000 mortgage, a rate of 6% gives you a payment of $2,398. If rates rise to 7.4%, which matches that long-term average annual swing, that payment jumps to $2,769. That's a $371 difference every month just from typical rate volatility. What's happening right now? Over the last 30 years, we've seen stocks, mixed, and mortgage bonds trending lower. Global bond yields, especially influenced by the Bank of Japan, are pushing our yields higher. That's one reason rates have been bouncing within a tighter band this year. In fact, 2025 has been what Housing Wire calls a quiet volatility year. So far, rates have ranged just 0.87% from a low of 6.17% to a high of 7.04. Smaller swings, yes, but still enough to move affordability for buyers on the edge. Home price expectations. What experts see coming. The latest Fannie Mae and Pulseonomics Home Price Expectations Survey featuring insights from 150 top U.S. economists, including MBS Highway, was just released. And overall, the outlook for homeowners is very strong. 2.4% home appreciation in the next 12 months, just over 20% appreciation over the next 5 years. If someone bought a $500,000 home at the start of the year, they gain roughly $12,000 in equity at year end and nearly $100,000 over 5 years. That's a huge return. And it's something buyers need to hear, especially when they're frustrated by current interest rates and having their money in the stock market. Inventory trends, the bigger differentiator. Inventory continues to be one of the biggest drivers of price movement. A state-by-state inventory breakdown shared by MBS Highway shows an interesting mix. Some states still have far less supply than pre-COVID levels, while others finally have more homes available. And not surprisingly, the states with tighter inventory are seeing higher appreciation, while those with more supply are seeing moderation. Even locally, we're seeing inventory slowly rebuild, but we're still well below historic norms. Now let's look ahead to 2026, a slow thaw, but not a breakout. So what does all of this mean for 2026? According to Housing Wire's economic outlook, 2026 is likely to continue what 2025 started. A slow, steady thaw in the market, not a sudden breakout. 3 forces that will shape next year. Uneven affordability improvement. Affordability is getting better in markets with rising inventory and moderating prices, often in the South and West. But in supply-tight states like many in the Northeast and Midwest, affordability will remain a challenge. 2, life events driving demand. From 2022 to 2025, the U.S. saw 4 million fewer home sales than normal. That created pent-up demand. And with 52 million Americans now in their 30s, life events, marriage, kids, relocations, downsizing are going to drive more sales, even if rates don't drop dramatically. Gradual inventory rebuild. Inventory is finally rising very slowly as more homeowners accept that ultra-low pandemic rates aren't coming back soon. More will list their homes. This loosens the lock-in effect that helps normalize the market. And final takeaway. So here's the bottom line. The housing market is moving towards balance, slowly, steadily, and in a way that continues to create strong opportunities for buyers and sellers. Rate volatility will still be part of the story, but equity growth, life event demand, and rising inventory will set the stage for a healthier 2026. If you want to help understand what this means for you and your situation, or if you want to personalize equity forecasts using tools like appreciation calculator, comparative market analysis, reach out to me, real estate broker Jessica Carter, anytime. And that's it for now. I have a holiday party to get to. Have a happy weekend.